Good morning, everyone. Today we're diving into the dramatic opening of the financial year, a period that's already proving to be anything but predictable. The stock market kicked off the year with a wild ride. After hitting record highs, the Dow and S&P 500 suddenly dropped, signaling a pause in last year's rally. Investors and analysts alike were caught off guard as the momentum that fueled months of gains seemed to stall almost overnight. The Dow fell nearly 1%, over 450 points. A reminder that markets don't move in a straight line. Even seasoned traders felt the jolt, as the sudden drop sent shockwaves through trading floors and newsrooms across the country. Investors are growing cautious, watching for signs of trouble ahead. Many are glued to their screens, analyzing every tick and headline, trying to anticipate what might come next in this unpredictable environment. This isn't panic, but a collective pause as everyone reassesses what's next for the economy. There's a sense of careful calculation in the air as professionals weigh the risks and rewards of their next moves. New government announcements and economic data have made people wonder if things got too hot, too fast. Reports of inflation, interest rate changes, and shifting policies are all adding to the uncertainty, making it clear that the market's path forward is far from certain. After such a period of strong growth, it's natural for the market to take a breather and for investors to cash in some profits. Many are choosing to lock in gains, while others are rebalancing their portfolios in anticipation of more volatility ahead. The big story: optimism is giving way to caution, and every bit of news is under the microscope. Analysts are dissecting every economic indicator, searching for clues about where the market might head next. This week's dip is a reminder that the economic journey is full of twists and turns. So stay informed, stay alert, and remember, in the world of finance, change is the only constant. Whether you're a seasoned investor or just starting out, understanding these shifts can help you navigate the ups and downs of Wall Street's roller coaster ride. When we talk about the market, we're really talking about a collection of indexes. These are like scoreboards that track the performance of groups of stocks, giving us a snapshot of how different parts of the economy are doing at any given moment. Think of indexes as scorecards for the stock market, each one representing a different slice of the business world. They help investors, analysts, and everyday people understand whether the market is rising, falling, or staying steady. The Dow Jones Industrial Average, or simply the Dow, tracks 30 of the largest and most influential companies in America, household names that have shaped the economy for decades. The S&P 500, on the other hand, is much broader. It covers 500 of the biggest businesses in the U.S., spanning industries from technology to healthcare to finance, making it a more comprehensive measure of the market's overall health. This week, both the Dow and the S&P 500 fell, signaling that investors are feeling uneasy. Concerns about the economy, inflation, and the possibility that last year's optimism might have been overblown are weighing on people's minds. The dip in the S&P 500 is especially telling. It suggests that caution is spreading among investors, as hopes for lower interest rates, something that usually boosts stocks, may not materialize as quickly as many had hoped. But there's a twist. The Nasdaq, which is heavily focused on technology companies like Apple, Microsoft, and other innovators, actually managed to rise slightly this week, bucking the broader trend. This split in performance shows that investors are growing more cautious about traditional industries like manufacturing and energy, while still placing their bets on the future of technology and innovation. There's a sense of excitement around tech companies, as people believe these firms will continue to drive growth and change the way we live and work. The rise of the Nasdaq, even as the Dow and S&P 500 fall, highlights a growing belief in the power of technology to shape the future, even when the rest of the market is struggling. It's a classic battle playing out on Wall Street. Old guard versus new, established industries versus up-and-coming innovators. This tug-of-war is what makes the market so dynamic and unpredictable. Investors are constantly trying to figure out what's next, not just what's happening right now. They're looking for the next big thing, the next breakthrough, the next company that could change everything. In the end, the story of the market is as much about the future as it is about the present, a reflection of hopes, fears, and the endless search for what comes next. President Trump announced a major oil deal with Venezuela, up to 50 million barrels coming to the U.S., worth $2.8 billion. The U.S. will manage and market Venezuela's oil, shaking up global energy markets. More oil supply means lower prices. West Texas Intermediate crude dropped over 1.6% to below $59.40 a barrel. Brent crude also fell, which could mean lower gas prices for consumers. The deal is more than a purchase. The U.S. will provide special diluents to help transport Venezuela's heavy crude. For U.S. oil companies, this new supply could squeeze profits and affect future plans. It's a geopolitical move with real financial consequences. The administration aims to stabilize or lower energy costs, but it creates uncertainty for other oil producers. For American families, the immediate effect could be cheaper energy bills and gas. The oil market just got a major shakeup. Jobs reports are the economy's monthly checkup, and investors watch them closely. Every month, these numbers offer a snapshot of how healthy, or fragile, the job market really is. For Wall Street, Main Street, and policymakers alike, these reports are more than just statistics. They're signals that can move markets, influence decisions, and even shape the direction of the entire economy. This week, the ADP report showed 41,000 new private sector jobs in December, less than expected. That's a significant miss, especially when compared to previous months. It's a sign that hiring is slowing down, and it immediately caught the attention of investors, economists, and business leaders. When job growth falls short, it can spark concerns about whether companies are feeling confident enough to expand or if they're bracing for tougher times ahead. The JOLTS report revealed job openings fell to 7.1 million, signaling a cooling labor market. Fewer job openings mean fewer opportunities for workers, and it can also suggest that businesses are pulling back on hiring plans. This trend has been developing for several months, and it's a key indicator that the red-hot labor market of the past few years is starting to lose some steam. For investors, this is a double-edged sword. Slower job growth can hurt profits, but it's what the Federal Reserve wants to see to fight inflation. If the job market cools too quickly, it could mean trouble for corporate earnings and stock prices. But if it cools just enough, it could help bring inflation under control, which is exactly what the Fed has been aiming for with its recent policies. If the job market cools, the Fed may lower interest rates. Good news for stocks and borrowers. Lower rates can make it cheaper to borrow money for everything from buying a home to expanding a business. That's why investors are so focused on these reports. They know that every data point could influence the Fed's next move, and that move could ripple through the entire financial system. Investors are searching for a just right scenario, not too hot, not too cold. They want to see steady job growth that supports consumer spending and business investment, but not so much that it reignites inflation. It's a delicate balance, and finding that sweet spot is easier said than done. The upcoming government jobs report will be the real test. Will the economy land softly or stumble? Economists, traders, and even everyday workers are waiting to see if the numbers confirm a gentle slowdown or hint at something more troubling. The outcome could set the tone for the markets and the economy in the months ahead. These numbers shape everything from interest rates to market moves. They influence how much people pay for mortgages, how companies plan for the future, and even how confident consumers feel about spending their money. In many ways, the jobs report is a pulse check for the entire economy. The stakes are high, and everyone's watching. From Wall Street traders to small business owners, from policymakers to families planning their budgets, the outcome of these reports can affect millions of lives. That's why every headline, every chart, and every number matters so much. The right balance could mean lower rates and a boost for the market. It could spark optimism, drive investment, and help the economy grow in a sustainable way. For investors and everyday Americans alike, that's the outcome everyone is hoping for. The wrong one could signal trouble ahead. If the numbers disappoint, it could mean more volatility, tougher times for workers, and renewed uncertainty for businesses. That's why, when it comes to jobs reports, the numbers really do matter. President Trump shook up both defense and housing this week. Defense contractors like Lockheed Martin and Northrop Grumman can't pay dividends or buy back stock until they speed up military production. Investors hated it, and stocks fell. In housing, Trump proposed banning big investment firms from buying single-family homes, aiming to help regular families compete. Blackstone's stock dropped over 5% on the news, as their business model was threatened. The hopeless competition from Wall Street means more chances for families to buy homes. These moves rattled markets, but could reshape who benefits from America's defense and housing policies. The impact was immediate and dramatic. Beyond the headlines, individual companies made waves. GameStop's stock jumped 5% after its CEO's pay was tied entirely to performance. He only gets paid if the company's value skyrockets. At the Consumer Electronics Show, AI and robotics stole the spotlight, with Nvidia at the center. Its chips power most AI systems, and its stock is soaring. Hyundai announced plans to offer humanoid robots to businesses via subscription, showing how fast robotics is moving. Mobileye's stock surged 11% after buying a robotics startup, and Samsung's buyback plan boosted its shares. The message innovation is racing ahead, even as the broader economy faces uncertainty. Investors are betting big on AI, robotics, and the next wave of tech. The future is being built now, and Wall Street is watching closely. Tech's momentum is reshaping the market landscape. While stocks swung, crypto found new stability. Bitcoin is hovering just below $90,000, and the wild speculation of past years is fading. Regulatory crackdowns and scandals are subsiding, letting optimism return. The market is maturing, long-term holders are sticking around, and new investors see real potential. Analysts say crypto enters 2026 on stronger footing, attracting more mainstream interest. The focus is shifting from hype to real-world uses for digital assets. Crypto's next chapter could be its most stable yet. A new JP Chase survey shows business owner optimism is dropping fast. Only 39% feel good about the economy, down from 65% last year. Mid-sized businesses are holding back on hiring and investment, worried about high borrowing costs, a cooling job market, and political uncertainty. Their caution could slow the economy even more. These owners see the real-world impact of economic shifts. Unlike the sometimes optimistic stock market, the survey is a reality check. Beneath record-high indexes, anxiety is growing. Main Street and Wall Street aren't always in sync. Business owners' worries could ripple through the economy. Their outlook matters for everyone's future. So, what does all this mean for you? The market's dip is a reminder. Investing isn't a straight line. Don't panic, but review your financial plan. The Venezuela oil deal could mean lower gas prices, helping your budget. The housing crackdown might make it easier for families to buy homes. A cooling job market could slow raises, but if rates drop, loans get cheaper. These changes affect your wallet, job prospects, and savings. Staying informed helps you make smarter decisions for your family's future. The economy's twists and turns shape your everyday life, so keep paying attention.